We are excited to announce the expansion of the Tax Analysts Awards of Distinction, recognizing individuals and organizations whose work has had a significant and lasting impact on tax law, policy, administration, or public understanding. The next category, U.S. Federal Taxation, is live. We are currently accepting submissions to honor contributions of measurable impact in the federal tax field. The future of tax policy starts with bold ideas and bold leaders. Nominate now through January 30th. For more information, visit awards.taxanalysts.org. Again, that's awards.taxanalysts.org. Hello! From Lisbon, Portugal, this is Tax Notes Talk.
Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Welcome to the podcast. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, Maltese Tax Primer. At the beginning of October, the podcast team traveled to Lisbon, Portugal for the International Fiscal Association's annual Congress. While there, we recorded several interviews as well as some sounds of the city, which you heard at the beginning of the episode. We've been releasing these interviews over the past month or so, and you can find the other episodes in the show notes. This week's episode features Trudy Muscat, a senior tax manager at Deloitte, Malta. Our discussion focuses on the evolving Maltese tax landscape, particularly its transfer pricing system, which has recently been implemented. We also talk about the OECD's global minimum tax reform and how Malta's tax system is adapting to the updates. Now, one note before we get to the interview, since we're recording this on the road, the audio may sound a little different than our usual interviews. All right, let's go to that interview. Trudy, welcome to the podcast.
Thanks, Dave, for the invitation. It's a pleasure to be here.
First, could you give our listeners a bit of background, tell them about yourself, what you do?
That's great. So I'm from Malta. I'm a lawyer by profession. I'm admitted to the Maltese bar. I specialized in international tax law at the University of Vienna, and I've been an advisor for 15 years now, focusing on EU tax law and more recently transfer pricing. I'm active on working groups and lecture and examine at the University of Malta and the Malta Institute of Taxation.
Well, it's great to have you. Could you tell us a bit about what is it like doing tax practice in Malta right now?
Well, it's evolving as with the rest of the world. As you know, there's so much that's been going on internationally, regionally, and of course locally. We've been following developments very closely with a view, Stewart, to ensuring continuity, stability, and competitiveness. I think if I had to pinpoint two main developments to front in terms of corporate income tax, I would say transfer pricing and Pillar 2 have been on the agenda.
Well, those are some big topics, so I guess we could get into those a bit. First, let's talk a bit about transfer pricing. I know that Malta's only recently getting into the game on transfer pricing, so could you tell us what's happening there?
Yes, super, definitely. So Malta is an OECD inclusive framework member and has recently formally implemented international transfer pricing standards into its domestic income tax legislation, which, to be fair, were not new to the tax system locally, despite their absence on the face of it from the law. So arm's length recognition is not new, it's the rules that rather are new. And therefore, what is new, I would say, is perhaps the statutory requirement for companies that are not SMEs to prepare transfer pricing documentation to support their intercompany and intracompany arrangements, because this also applies to permanent establishments. Therefore, as of 2024, we have transfer pricing documentation requirements for companies that are not considered to be small and medium enterprises under the state aid regulations in the EU, and whose intragroup transactions exceed the minimis thresholds. Essentially, the aim is to cover cross-border arrangements and exclude small ventures to avoid being overburdensome.
This sort of raises one additional question for me. What was it like with transfer pricing before the rules were in place? How did companies know what they were expected to do?
Yeah, that's a great question. So Malta, anyway, expected that pricing was at market rates, which essentially means at arm's length, but we did not have the requirement to prepare documentation locally. So essentially, we still had anti-abuse rules and the requirement to ensure market rates. What we have now is an express requirement in the law to replace your contractual pricing values on the tax return with arm's length values and support that with documentation upon the request of the taxpayer. So our guidelines specifically, and unsurprisingly from a continuity perspective, refer to the OECD transfer pricing guidelines for methodology application and documentary construct, and of course the AOA, the authorized OECD approach for PE attribution. Still early days in terms of revenue packages, but we don't expect seismic shifts there.
Support for this podcast is provided by Avalara. As a tax professional, you already know compliance isn't just about rates and returns, it's also about accuracy, efficiency, and protecting your business from unnecessary risk. That's why so many finance teams rely on Avalara. Avalara automates sales tax compliance end-to-end. Real-time calculations, more seamless integrations with leading ERPs and accounting systems, and scheduled filing across thousands of jurisdictions. With dashboards and data designed for professionals who live and breathe tax, you stay in control with the information you need in a centralized platform. Free up your team's time, reduce audit exposure, and scale compliance with confidence. Visit avalara.com to learn more. That's avalara.com.
And so why now? Why did Malta decide that this was now the time where they needed to codify these changes?
I think it's just a development of where things are going internationally. We've seen an increase in focus since the BEPS project on transfer pricing, and even from an EU perspective. You, of course, know about the proposed transfer pricing directive within the EU, an initiative which hasn't really caught on, but which we're now following because of the weighting being discussed between the Commission and Council in a perhaps resurrected transfer pricing forum, which would issue arm's length recommendations that the bloc will expect to follow. So essentially, it's making sure we're on the same level playing field.
And so how have things gone? How has this process happened as Malta has been implementing its new transfer pricing rules?
Essentially, there's not been, as I mentioned, a seismic change. It's just informing taxpayers to ensure that their arm's length values are properly supported and supported on the basis of the OECD transfer pricing guidelines. So it's nothing overly new. I would say people we speak to are used to applying arm's length anyway. This is an international standard that is expected internationally. So, and even in Malta, there was always the expectation that international standards were applied. So, from our perspective, while yes, we have new rules, while yes, now we have a framework, but nothing much has changed except for the fact that you would need to maintain your master file and your local file locally.
Now, when Malta was doing this, were they looking at examples of other countries that have recently adopted transfer pricing rules?
Yes, Malta does do its homework. It does look at other jurisdictions, especially jurisdictions which we typically have parallels in its statute. So, for example, the UK, Ireland, etc. That is natural for Malta. But then with a view to ensure that there's no big bang, with a view to ensure that there are de minimis thresholds, that it doesn't apply to SMEs, so that it doesn't become over-complex for companies.
Is there anything going forward that you're concerned about? Anything that companies may have difficulty adopting? Or does this seem like it's more business as usual, just more formality?
Yeah, I would say the latter, Dave. I think the concern, rather than local, is regional and international. We've all seen the development of the BEPS project on the Pillar 1 side. Recently, the European Parliament Econ Committee also issued some new proposals on the BFIT directive, which revolved around the resurrection of the economic significant presence PE. I'm sure you've heard. So the proposal is for there to be a permanent establishment where you have more than 1 million revenue in a jurisdiction. And this does dovetail to an extent with the thought process behind Pillar 1. So we've got to see where that takes us and how that impacts transfer pricing within the EU. So from a Malta perspective, I think the discussion revolves very much around the preference for global rather than regional alignment. So, for example, we recently had the Inclusive Framework Amount B commitment in the context of the OECD transfer pricing guidelines, something that was implemented via international political commitment.
Could you explain that just for listeners that may not know what Amount B is within that context?
Yes, so Amount B essentially is an internationally agreed under the OECD Inclusive Framework Standard, whereby there is a simplified and streamlined methodology for pricing, baseline distributing, and marketing activities. This makes it easier when you have low risk, for example, distributors in developing countries.
So, since we've just talked a bit about Pillar 1, let's change gears and let's talk a bit about Pillar 2. We have this globally agreed on, I guess, two-system standard now of minimum taxation. So how are things playing out in Malta? How is that being implemented?
Yes, so in terms of Pillar 2 adoption as an EU member state, Malta has agreed to adopt the global minimum tax rules as adapted by the EU for the internal market. We have availed of the Article 50 deferral, which turned out to be wise, I would say, given the turmoil. I'm not sure whether you've heard, but for example, a number of German Länder just came out and asked the EU for potentially the suspension of the directive within the EU until there is a bit further clarity about how the EU is going to consider the US rules. So, for example, now we're speaking about the new net CFC tested income rules, which are the successor of the Guilty rules, and we're speaking about whether they can be equivalent in terms of parallels with QDMTTs, qualified domestic minimum top-up tax systems, or whether it could merely be a safeguard for EU purposes, for the directive's purposes. And over there you start thinking about then what else could be a safe harbor for EU purposes. So there's quite a lot of turmoil, so it's not a bad thing that perhaps Malta has applied the deferral. Perhaps one important thing locally is that in the interim, Malta has domestically introduced an elective tax system. So this is quite new to facilitate essentially the globe transition for entities taxed in Malta. So essentially the tax base is the same. It's your normal corporate income tax base. However, instead of applying the full imputation credit system that we have in Malta, one would apply a final 15% tax. So this is not a QDMTT, Dave. It merely allows MNEs to easily, or at least more easily, bridge the gap between a non-implementing jurisdiction and an implementing jurisdiction by reaching the minimum rate.
Support for this podcast is provided by Crux. Tax professionals know that investing in high-quality tax credits can deliver meaningful savings. That's why a quarter of the Fortune 1000 is actively participating in the tax credit market. But it can be hard to source, perform due diligence, and execute energy and manufacturing tax credit transactions, especially when tax professionals are busier than ever. That's where Crux comes in. Crux is the trusted partner for transferable tax credits and tax equity investments. The Crux team has facilitated over $30 billion in tax credit transactions throughout their careers, including over 120 transactions at Crux. Crux offers a full-service execution team, industry-leading market intelligence, and AI-powered tools bringing certainty and predictability to the transaction experience. Now your tax team can create financial value for your company, secure in the knowledge that you're getting the best the market has to offer. Ready to get started? Learn more at cruxclimate.com/contact. That's cruxclimate.com/contact.
So how much of a tax change is it for Malta to go from the tax regime that they had before Pillar 2 to, I guess now we have this elective tax going forward? What sort of changes can we expect to make Maltese tax compliant with Pillar 2?
Yes, so as with every other jurisdiction, our tax system needs to live up to the expectations of the directive to the extent that it will remain in place. So this approach is a step-by-step approach. So we're looking at 2029 for full adoption of the directive and therefore the implementation of a qualified domestic minimum top-up tax. So in the meantime, companies at least have the option, if they wish, to still use the income tax base, which of course would be different when calculated under the GLOBE rules, but at least reach the minimum tax applied in other implementing jurisdictions of 15%. So it is a phased approach, Dave, to avoid shocking, if you wish, the market.
So how does this new Pillar 2 system interact with the new transfer pricing rules that Malta has?
That's a great question. So I would say increasingly, Dave, the nuances of the interaction of the arm's length principle with Pillar 2 are stealing the spotlight, to be honest. So given that transfer pricing drives profit allocation, there's a lot of sensitivity around the arm's length computation of a tax base that is subject to the minimum tax assessment. So groups find themselves faced with additional top-up tax even where the transfer pricing is at arm's length. This is definitely one of the issues we're facing, and I would say another issue is the effect of transfer pricing adjustments on the income inclusion rule. So you have ex post transfer pricing adjustments that can lead to double taxation and retroactive top-up tax if the tax information return, meaning the Pillar 2 return, has already been filed. And therefore consider attempting in a mutual agreement procedure to reach a compromise not only on the cross-border profit allocation, but also on the effective tax rate and the top-up tax calculations. You can imagine that that would add to several other layers of complexity. And this is where we expect complexity to arise in terms of the relationship between the arm's length principle that is enshrined in the GLOBE Directive and the Global Minimum Tax Directive, and of course, transfer pricing rules, which are becoming increasingly relevant and increasingly under scrutiny by the tax authorities.
So I guess one of the major issues for all companies going into all these, tax regimes that are in transition is getting to some sort of level of certainty. And so what is Malta doing as far as, giving companies that certainty?
Yes, so as part of the introduction of the transfer pricing rules, the tax authorities have also introduced formal unilateral transfer pricing rulings and also a framework for advanced pricing agreements under bilateral tax treaties. Of course, again, this was already there. These were already available under previous rules, but now you have a formal framework. So in terms of the unilateral transfer pricing rulings, these, for example, are intended to assist the taxpayer on the application of the rules or on the tax treatment of cross-border arrangements. And the rulings can be valid for 5 years unless the commissioner considers that they should be valid for less. And they could also look at 3 years prior. So with advanced pricing agreements, the framework is quite similar, but of course this is a bilateral or a multilateral scenario. And from my experience at least, revenue tends to align quite closely with international standards and tends to listen to the taxpayer.
Another issue that's out there is the questions of tax transparency. So what is Malta doing in that space?
Precisely, and as you know, the EU has introduced an amendment to the Accounting Directive whereby certain groups are now required to report certain information, tax information, under the public country-by-country reporting system. And for example, for countries with a December year-end, their first reports start coming out in December of 2026. So I would say that it's becoming increasingly important to base your transfer pricing strategies, your group strategies on commercial rationale, and as we always say, to document and defend, particularly when the reporting framework is becoming increasingly transparent.
Well, it sounds like there are a lot of moving parts going on in Malta, so it's going to be a country to keep an eye on. Trudy, thank you for walking us through everything that's happened so far.
Most welcome. Pleasure to be here.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at TaxNotes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk. Tax Analyst Inc. does not provide tax advice or tax preparation services. Nothing in the podcast constitutes legal, accounting, or tax advice. A full disclaimer is included in the transcript.